We're on.
Thank you.
Good morning, everyone. I'd like to call the Audit Committee meeting of May 23rd to order. Will the secretary please call the roll?
Private members, Michael Spitzer, Chair.
Present.
Mark Kaplan.
Here.
Bud Larson.
Present.
Public members representing Comptroller Scott Stringer, Jacqueline Thompson.
Here.
The representative for the mayor, Bill de Blasio, will not be here today. And the representatives for the public advocate will not be here today. We still have a quorum. Thank you.
Thank you. I'd like to have a motion to accept the draft minutes of April 25th.
So moved.
Okay.
Seconded.
Next up is the Controller's Office for the report, the audit report to the mayor and the city council. Good morning. Would you like to introduce yourselves?
Good morning. I'm Marjorie Landa. I'm Deputy Comptroller for Audit. I'm here with my Chief of Staff, Keith Schwam, Faggy Hornick, who is Assistant Deputy Comptroller, Mike Montemuro, who is our Director for Quality Assurance, and Edward Carey, who is Assistant Deputy Comptroller.
Julia's here.
And we're just being joined by Julia Davis, who is the Director of Investigations. Good morning.
Good morning. Thank you. Would you?
Thank you. Well, I really want to start by thanking you for giving us an opportunity to tell you about what we've done in this last year, and really to start by thanking everybody I've just introduced and our amazing staff, because we've had another, I think, tremendous year in our audits and investigations. There's a lot of things we've not done before, a lot of things you will see that are quite familiar, but we could not do any of it without an amazing staff and these folks here to lead them. And I've been in city government a long time. I've worked at 3 different agencies, and each one has been better than the next. They've all been terrific, but I've never worked in a place where the work product is so collaborative. There's no way to do this. There's no one person. The controller gets his name on these reports. I get my name on the report. There is an army behind us, and I don't know that anybody appreciates what incredible work from the staff auditor level up through the supervisors, the managers, to the assistant deputy controllers. QA, very active role from their side. We really have a tremendous group, and they all work together, and I just need to thank them publicly because they're terrific. So a little bit about what we have done in this past year we're reporting on. We had 76 audits and special reports, and that included 63 GAGAS audits, and 50 of those were full reports. We had 13 letter reports. We had 13 special reports and investigations. And so our investigations group, it's research and investigation. They do a wide range of things, not all of it. In fact, most of it doesn't end up in reports. It happened in this last year. There were 3 public reports that went out. I'll talk a little bit more about at least one of them or anything that you have obviously a question about. Our calculation, about $66.2 million in actual and potential savings, and another $1.5 million in cost avoidance in this year. We also completed our peer review. As you know, we are peer reviewed every 3 years, and we got a glowing peer review in October.
Excuse me 1 second. Who were the reviewers?
Who the reviewers? It's the same firm that's done it for the last several years. That's come through. It's an independent peer reviewer. We do a public bid, and they're the ones.
Who was it?
What's that?
Who did it?
That's George Shimo, CPA. It's a private firm. His background is he was the chief internal auditor for the New York State Comptroller's Office. Once retired from there, he worked for the Institute of Internal Auditors, doing peer reviews. Once they decided not to any longer do independent peer reviews, he went off on his own with staff from around the country of different specialties to do peer reviews. So he's.
And I will say we do have a challenge with the contract solicitation, because there are fewer and fewer entities that are qualified to do the kind of review that we need. And so we've had some conversations with the accountancy group, who has the pre-qual list of accountants. We'd love to develop a broader bench to come and bid on our jobs. But as I said, they're for peers, that we're a unique shop. There are very few that do what we do and do it at the scale we do. So we're working to develop that because, it's all well and good to have one person who is terrific. We want a group of people to choose from, and there were, initially, we had to have some interest, but it's a smaller arena. So on the follow-ups on our audits, as you know, we go out and we solicit every agency to respond on how they have been doing in following up on the recommendations. And we had 83.8% of our recommendations adopted by the agencies, which is the highest number we've had in about 8 years. I think that's a testament to how well we're working with the agencies, as ferocious as the pushback often is in them telling us we have missed the mark, we don't understand. They more often than not adopt the recommendations. Sometimes they will say, we've already done it already, so we don't need to hear from you. Of course, they did it while the audit was in progress because we pointed out problems. We don't care. As long as they make the corrections, let them take all the credit they want for it. That's terrific. So one other sort of broader theme, I think we've talked about this, and I have in past years, and you've commented, we have a lot of audits that are repetitive, but they're really thematic, and I think they're hugely important. They're not always the ones that get the big attention, but as someone who's been on the agency management side and been audited by this shop, I know how important they are because they taught me and my agency about local laws and various requirements we weren't always aware of. So just generally, one of the big themes you'll see in this year's audits is language access. There's several local laws and executive orders related to that. So we've been going through every agency, making sure the websites are accessible, the materials are accessible. We're going to continue doing that. I think we had 9 audits this year. You'll see more. Another area that we've done a lot of work on is inventory. And we've been looking at small agencies and large agencies, and we're looking at computer inventory in particular, because that tends to be something that is highly valuable and highly portable. And it is remarkable the number of agencies and entities that are doing city business that say, we don't have time for that, including the Department of Education. Keeping track of our computers too hard, and because they move around so much, which is exactly why you need to keep track of them. And we did 10 of those this year. We are starting to look at the local law that requires defibrillators in public buildings and in parks. So we did one in this past cycle. You'll be seeing more of those. We've continued to do the recycling audits. Cars, Easy Pass, that's a gift that keeps giving because you get new people in an agency. They have no idea what the rules are around those things, and our coming in simply teaches the agencies the rules. And, many who've seen us before are compliant. We also have started a number of audits. We did some in the prior year. You'll see more coming, having to do with clearances for childcare workers, looking at daycare centers, and we're doing that in a whole different number of formats. So what you'll see this year, 3 childcare centers that we did those audits of. That had started out as an audit of ACS, which was really interesting, looking at their oversight of where they're giving their money and these centers where the vouchers are going. And in the middle of it, the state came in and said, oh, ACS can't have that information. They can't get the, SCR, the clearance for criminal records. They can't get that. So we had to go to each one of the individual daycare centers, which has been very interesting, plus ACS for other information. So what we thought was 1 audit's now turned out to be 7 audits just on that particular initiative.
Did they say why they can't get it?
The law, there is very strict confidentiality around that, but for decades, ACS had been getting it. ACS is responsible for overseeing these entities. ACS sends, and authorizes that their vouchers can be used there. And it was a decision out of the legal department. I'm a lawyer. I would have taken a different position interpreting the same statute, not my field. So, their legal counsel issued an edict and changed their own practices for years. So it really puts ACS in a bind because they are not given access to the same information that the centers have. So, and that just to give you a couple of highlights of audits, and then
Have you commented on that, the distinction between the two, and make a suggestion about a legislative remedy?
we did not make a suggestion on the legislative remedy. There's a very robust set of laws in place, but that's actually a good suggestion because it really does tie
Yeah,
the city's
It
hands.
seems to me that you could make a real contribution there.
Yeah, I will take a look at that. I think that's a great suggestion. Couple of highlights of some of the audits that were more notable. I think the ones I've just described to you, you'll flip through those in the book. They're not the ones that get the press. They are the ones that make the agencies really function, I think, in a meaningful way. As do the others. So among other things, in this last year, we looked at preventive maintenance and repairs of elevators and escalators in the subway system. And it was really an eye-opener. Among other things, what we discovered is they had these wonderful metrics where they showed they were, 93, 94% meeting all of their targets on repairs, and these, elevators and escalators were functional. When we looked deep into the metrics, we saw the denominator did not include any repairs that were being done by an outside contractor. So if you all take the subway, as I do, I would go through what was then the Broadway Nassau station, and for a decade there was no functional escalator. That wouldn't have counted in these statistics. So looking deep on statistics has been something the Audit Bureau has always done. The Research and Investigations Bureau is also doing, and it's remarkable what we found there. And this is a great example of an audit we did where the staff on the ground was hugely interested in what we were finding and very cooperative. The administration professed to have no interest in what we had said, but we could see changes being made along the way based on things we were able to point out. And I think that's one of the strongest affirmations of what we do. We also did an audit of the public, the POPs, the privately owned public spaces, yes. I have to remember the acronym, which is, where a building gets extra floor space and in exchange for giving a public space, many of which are these wastelands, with leaves and.
Especially on Fifth Avenue with Mr. Trump, right?
Yeah, well, he has several. They were part of the audit. He's got 3 buildings with POPs in them, and there were non-compliance in each one of them. He had been sanctioned before we got there. There was still non-compliance when we got there. But at least he had taken out the stand where he had his hats for sale, rather than the benches for people to sit down. So the benches were back, the hats were not. That was remarkable because we were able to, with the gift of summer interns, look at every single POPs, that was 333, and inspect them, and do something that the regulating entities, the Department of Buildings and the Department of City Planning, are not able to do. And there's wild noncompliance right to the point of one of them actually having a building built over it. So there is, it's just not there. Others you see, we found with signage and a guard who tried to detain our people because the public was not allowed into the space they went into. So that's one for legislative change that we have been working on because the noncompliance there is extraordinary. And we hope that the public attention in this one
Gee
will
whiz,
help
I
change
can
that.
think it'd be field day for the class action bar.
You would think. So, it
we'll put
change
some
one way or the other. On the financial side, we continue to do audits of the Department of Finance. And among the more notable, there were 2 in this past period, one having to do with the C-notes, the senior citizen homeowner exemption, and the other having to do with the veterans exemption. tax exemption. But we had very similar findings in both the much bigger numbers on that, but same kind of problems in that, with that one in particular, they were supposed to be doing a check every couple of years on whether the owner of the property was still a senior citizen, still alive, still within the income guidelines. And they weren't bothering to do that. And so upwards of $50 million we calculated had been lost in taxes. In addition to doing the 2-year review, they were supposed to look for, not allow corporations, it only goes to individuals, just simply looking at the LLCs and the Incs who own the properties. We found that went into that $50 million calculation. And similarly, there was sort of pro rata adjustment if you have a multifamily building and you're living in one unit, but the others are not occupied, you also have adjustments. So all of that was not done for this exemption, for the veterans exemption. A lot of money involved, and I will say, finance has taken notice, a little frustration they haven't recovered all the money, but they are recovering some of the money, and we have urged them to continue to do that for past money, and they've certainly changed the policies going forward.
Is there
On
any
that
chance?
process, the
Yeah.
2 years, was it a failure for people to file the form that was the principal problem, or the failure of the department to check?
It was both. It was both. People weren't filing, they weren't insisting on the filing. Yeah, and some of that is, we found this in a variety of the audits we've done, where the statutes have said you have to do a check, and they've not done it.
They
So-
don't have any facility to do any automated checks against, like, Social Security death records.
They have been doing that, but what they do now is going forward. So going backwards, they're not checking. Okay, so they're not recovering money, but they are now doing that going forward.
When you say not going back, I mean, they're doing it as of now. So if the
Yes, they're
person's
doing it
dead,
as of now.
They're not getting the
Yeah.
benefit going forward. They're not going back
Right.
to try to recoup.
That's right.
Okay.
That's right.
Is there any possibility of doing what's been done in another case of transferring the cost, the collection process to some private entity in exchange for a piece of the action? You know, that's how the utility bills are handled.
Right.
Is there any reason why this sum of money, these obligations, couldn't be turned to some pot, which in turn would collect it for a piece of the action?
I don't know a reason why that wouldn't be possible. I don't know if there's any special exemption for tax liens as opposed to any other kind of liens. I know the law department's been doing that for decades. They've turned over all of the collection work that they used to do internally to a private contractor.
We see that periodically here.
Yeah.
Why couldn't you, where does that get looked into? Because there's a lot of money there. It should be easy fruit to collect. And the city wouldn't have to spend any money to collect it if you privatized it.
The rationale we got from the Department of Finance wasn't, it's too hard to go back, it's that we thought it might be unfair to go back. And we took issue with that. So I don't know that they don't have the capacity. They didn't say that to us. What they said is, look, you got somebody who's there, they relied on this, it might have been the wife, it might be unfair, it might be this, they didn't know. You know, our view is you take every case as you find it, and if it's a corporate entity, there's no question you would recover that money. And if it is someone who is above income, because it's the child who's a partner in a hedge fund who inherited the property, you'd be recovering that money. If it's somebody who's low income, you might make a judgment the way you do with everything. But they took issue with that.
Well, if you privatized it, the judgments would be different. Is it
Well,
collectible or not?
Right, and their view is, we don't want to do, well, I didn't suggest privatizing, but their view was not about the capacity. It was, we think it's unfair. We think it's been done, we'll just move forward.
I don't see we have any place to help in this area, but it would seem to me that to suggest someplace in the city, somebody look at this as a quick way to get some money and without spending any of our own.
I think that's a terrific idea. Thank you.
There also seemed to be an issue that somebody purchased a property that had the discount, and they continued to get the discount, and they didn't want to go back against those current owners to recoup those monies. Was I reading that correctly?
Yeah, that is the way they were viewing it, that somehow they were innocent, but, it comes up on your tax bill that you're getting that exemption. So the taxpayer gets notice, And, you know, the innocent taxpayer is a stretch in our view, because you know what you're getting. You look at your tax bill. So it's been an ongoing issue. But what's interesting to me really is the similarity in the problems we found across the board of not even doing the most minimal checks. They were not. They're now doing it, you know, for corporations. When you have an exemption, a benefit that's going to somebody that's supposed to be a low-income individual, a senior citizen, a veteran, that can't be an LLC. You know, right there, it's easy. We're not making anyone work hard on that one. So just one final matter to highlight, and then I'm happy to take any questions you have. One of our investigations that we did write a report on this year was actually in part an outgrowth of an audit. We had an investigation that was done of daycare centers in homeless shelters. What we found, in part through the audit we did about conditions in homeless shelters, is that there were daycare centers on site, but many of them were not actually regulated. They were kind of there, and what we determined is there was a loophole in the law that did not require them to be licensed and regulated in any way. They fell between the cracks in the state law. And so we, in combination with audit staff and investigative staff and others, went out and took a look at every single one of these centers that was unlicensed and made a report back, and the law has now been changed to bring those centers under the ambit of the regulatory structure that had been there before. And with that, I'm happy to take any questions you might have.
There was a couple written questions submitted. Did you get those and have responses?
Yes, and I'm sorry, I should address those. I knew there was one about SHE, and then there was the question about the welfare funds. And that was the last thing here, and I didn't look down all the way on the page. There were the issue about welfare funds is one of the challenges we face at all times. As well, you know, every city agency, every 4 years, we work mightily to make that mandate. We did it this year in December. We concluded a 4-year cycle. It means we can't audit everything we want to audit at all times. So what we've done with the welfare funds is sort of twofold. I think you've noted in the questions, the audits, we do one or two, you know, a handful every year of individual funds, but there's systemic problems there. So what we do in addition to that is the survey that we do, where we are at least reporting on some key metrics related to the funds, the amounts of their reserve, the amounts of their overhead, their expenditures, things that are really key metrics that I think are important to the unions that sponsor these funds and to their members to see where their money is going. One of the unfortunate things is we are not the regulator, and maybe that's fortunate for everybody, but we're not. So as with all of our audits and recommendations, we can report, let you know what's going on. So the survey is a way that we have come up with. It's well before my time, and I think it's a really smart approach to trying to address the limitations on what the world does, not just us, on letting everybody know what's going on with these funds.
I think part of the question was whether or not there was a suggestion as to how one might address the broader topic of welfare funds and manage them. Since year after year, we have the repetitive same problems. There are funds that are not, as you said, there's no oversight of the controller, the mayor, city council. And when you look at the individual audit here, I think that the general reader of the audit doesn't understand the size of the issue, because while we only audited a couple of funds this year, if you look across the city on an annual basis, about $1 billion plus is sent to welfare funds that are administered by union funds, which seem to have these kind of repetitive problems. And I guess part of the question was, if there was any suggestion as to whether that overall framework might be reconsidered to where if the city is spending $1 billion on something, that there might be a way that it could take advantages of efficiencies in purchasing, coordination, and a whole host of items.
Yeah, the question almost answers itself in terms of the amount of money and the fact that this is being done in such a disparate fashion. By definition, you don't get the same efficiencies. Plus, the lack of oversight, breeds the problems that don't just become evident through our audits, they become evident through indictments, and we've seen that.
But I think part of the
Yeah.
suggestion was, the way it is, it's buried as the last two items in the audit, which
Mm-hmm.
sound kind of minor. And if I'm Joe Blow and pick this book up, I don't know that I'm talking about a $1 billion
$1
entity.
billion. Yeah, it is, I will tell you, because it's obviously limitations what audit do, but I have been very involved with the office as a whole looking at this issue. A variety of things have come up over the years. And it is something that we're very, very mindful of, and we are anxious for suggestions because it's actually not solely a city problem, it's a state problem. And, that there are legislative issues on both ends. It is something we're actually working on, and we really are open to constructive suggestions
Right.
as well, but it's something that the office is.
I think it would be helpful if if there was more expansion on the magnitude of the problem that we're talking about. Because, if you weren't somewhat familiar, this would have been looked at as the most incidental thing in the report, because it's two little funds at the very end of the report, and it's over $1 billion.
And I appreciate that, and actually, I think that's a very good suggestion just in and of itself, because the survey is obviously an effort at transparency, but it's transparency that is like a book of numbers, so most people would just yawn.
It'd be helpful
And it's
if
a way to get that
In
up
some
front in
format,
some
you can
way.
take that information and provide it to people who might be able to have some influence on this.
I think that's great. I don't know if you're aware the IBO issued a report this year on, I think it was the IBO, on the welfare funds. It's something that is getting a little bit more traction, which is to the good, and I think your suggestion's a good one.
Okay, thank
I
you.
mean,
Yeah.
especially in these two, the administrative costs were 27% of the income.
It's one of the reasons why we looked at them. And there have been changes within that fund, and we're hopeful we're not done yet. That's, not just with that, but with some others. And this is a very active part of the audit part of our group, the investigations part of the group, and frankly, what the issues you've raised, they have been, our general counsel and others in this office have been working on this for a
And
while.
I wouldn't be surprised if you went through a large number of them. The 20%'s not that huge an outlier. It might be an outlier, but
Well, you can-
unfortunately, they're not by themselves.
Yes. And particularly, frankly, when we do a deep audit of anything, for instance, when we did the Success Academy audit in this last year, we found undercounting of administrative expenses. So when you really dig deep, all this is based on their public reporting, but if you look at how they categorize things, sometimes there is an underreporting what's administrative as well.
If I can. Sure. The Success Academy was high on the list to ask questions about, because it's clearly not doing what it should do. And one of the concerns I have, and that's where there are things here, like the inspection or the bus drivers and that sort of thing, in which you clearly have a roadmap to litigation if something happens. And it would seem to me that at the very least, if I were the city, I would try to say, this was my point, I stopped it, not a question of, and there's no indication here that the agency is going to do that. And if there is an accident and you haven't done it, just figure out how big the check will be.
I think that's absolutely right, and generally, that's as much a motivation as anything else to get action. And I would hope that they would at least be motivated for that, if not the safety of the children in the buses.
Is there anything we can do as an audit committee to help you motivate them? For
I
example,
believe you've had the suggestion before about.
I always have that
Yes, about calling on them to answer to you, since we try to get them to answer to us, and we do come back, and it's one that may be, from a fiscal point of view, really quite worth our while to go back again.
I'm sure there's somebody behind you who's doing it, but if you read, there's several places in here in which, if anything happens, the city's going to have a big chunk of liability,
Right,
and that's not good.
right. Right, which is something that we do call to their attention in the audits very often, in the discussions and in the aftermath. It would be great if there was some way we could make them adopt the recommendations. I'm pleased that they've adopted so many, but some of the others like this.
Take one of these organizations, someplace in the city administration, the people there must report to a higher authority.
Deputy mayors.
All right, okay. Well, is
Yeah.
it possible that higher authority said, no more fooling around, do it tomorrow?
I would think that would be terrific. That's me
Well, why isn't
personally.
that done? I'm
I
looking
can't,
behind you.
yes. I was going to say, I can't answer for the mayor or the mayor's office, but it would be terrific.
You know, in this case, you talk about lives.
That's right. I mean, money
We
is
just
important,
had
but
that
it's,
horrible bus accident, it was in New Jersey, where the guy
Right.
clearly had no business driving.
right.
And so are we an accident waiting to happen, and we're all going to look at each other and say, I'm sorry, are we in a position? I apologize. Are we in a position where we'll all feel foolish at some point?
I hope not.
So do I, but it's a
Yeah.
concern. Now, there are a couple of other places where there are all kinds of things where the community boards, which tend to function independently anyhow, don't follow up. What's the mechanism for making them follow up?
And that's something that should be going through the community boards and through the borough president's offices, which hopefully they are doing because they do get copies of these reports. They are aware of what's here. We get a lot of very good response from the borough president's offices. They do comply, and I think they are concerned about the community board compliance, and that's our most effective mechanism. They're elected officials. I think that, you know, the borough presidents, and I think that's all to the good, because that helps the public sort of be on notice, and they are a notice to the public and the press, and make sure, we hope, that the boards are following things. The community boards are a terrific example of where what appear to be uninteresting audits of their computer inventory are hugely important, because somebody who is volunteering time, or they're, you know, in here for some short period of time, or they, you know, it's not a high-profile position, so they may not know the administrative rules. They certainly know them by the time our auditors are done with the work that they have to do. And I think we do a great service ensuring these things actually do eventually get complied with.
Just to follow up on, you know, like the Success Academy, like one of the things that when I read this, you make a lot of recommendations. And then in this one in particular, there were 28 recommendations. And then it says most of disagrees with most of the findings, but we don't know what they're disagreeing with.
So
And I realize this is a
Yeah.
summary, and probably the whole audit report is probably as thick as this.
The audit would show that, Mike.
Yeah.
Yeah, no, I'm
detailed
just saying,
audit
in
report.
reading this, I
Yeah.
don't get really a sense, how serious are the ones that they disagree with, or,
Well, I will, for them, and it is not unusual even for the agencies. DOE
Same thing.
is
It
one of my
goes-
favorite, will say, we disagree with all your findings, you're wrong, you're wrong, you're wrong, we're going to actually follow all of your recommendations. It kind of comes quietly at the end. So, you know, there's a posturing that goes on. You know, with Success, because that's obviously a very high-profile audit that was done. There are a lot of vested interests who followed that, and I will say there was a lot of follow-up from every possible community on things that we found. So DOE has oversight over them to a degree, the state has oversight, and they're very aware of the findings in the audit, including each of the pieces, because they were very, very varied. So there was some very, you know, sort of very nerdy accounting matters in there about the way they were identifying expenses and things that were administrative, not administrative. There was double counting in terms of payments to their the entity which kind of is overseeing their work, which is just another arm of Success, their management company. I think we're getting, I'm hopeful, from the way they responded to the actual recommendations. There were many changes that were being done as a result of that. And then from the responses that we got and follow-up questions from not just the press, but all of these various entities who have a hand in looking at charter schools, both pro and against. We're not. We're just kind of there to do the audit. But we got inquiries for factual information. We provided it, and I hope that means there's more oversight being given to some of the findings we had in the compliance.
On the peer review, I'm sorry I was late, I got delayed. How long did they spend with you?
They spend on-site roughly 2 weeks.
2 weeks on
Yeah,
site?
Yeah. Yeah, and they do very detailed dive in to the work.
And the audits that you highlight in the front of the report's a little different. Those they focused on?
They choose, we don't choose for them. We'd love to choose for them, but we don't. So they actually pick out, they look at the body of work that we've done. They tell us what they want to look at. They tell us who they want to speak to. Just like our audit subjects, we would love to be able to tell them what to look at, but we can't, we don't.
But all these, I'm sorry, these particular audits that are in the front of the presentation, they had focused on?
They were not all the ones that they focused on. They're picking, I think, Mike could probably tell you more particularly because I did not go in to see what they were looking at. I was interviewed by them, but, they worked through our
Of course,
QA group.
usually you don't put, the format of this report is different than past years.
We did that in part trying to respond to questions you folks had had about trying to make this presentation more accessible and less.
Okay.
Yeah, so that was an attempt to change
I
the
believe we
format.
asked for like an executive summary.
And that's what we attempted to do here.
Yeah, it's big dollars.
Yeah, and so we picked out, that's where we get to pick. These are the ones we think are really interesting. I highlighted all of these sort of systemic ones because I personally think they're extremely important to the operation of city
Okay.
government. But the ones in the front of the book are definitely the ones that are bigger, more dollars, more impact in terms of systemic problems.
There is one systemic problem that I'd like to just ask about, and that is, it looks like the concessions that are reviewed here all have issues
Yes,
of honesty and morality,
among other things.
among other
They're
things.
very similar issues. It's kind of
One
remarkable.
and it's been going on for years.
Yes.
So other than your calling attention to it in an audit, what steps are being taken to enforce the rules and to make sure that these people who have pretty great contempt for the rules are brought into compliance?
So among other things, of course, the Comptroller's Office sits on the FCRC, and they're very, very aware there's coordination between our audit bureau and the people, the Comptroller's representatives that are there. So these issues do not just live in our audits. They're actually very alive, and they're alive when new concessions and leases are being discussed. So this office is making a concerted effort not to have this just sort of go off into the ether because it is a systemic problem. It's been one that's gone on
Forever.
And I'm hoping at least through that side of the world, with the Comptroller's Office working in a coordinated way, that there will be more compliance, there will be, because the entities are going to see, as are the agencies, that it's going to be a hard time getting a new concession without showing compliance with past problems, and not just ones we find in audits, because we don't audit everybody, but there is absolutely a coordinated effort being taken in this office.
There is.
Yes.
A lot
There
of
are
money
no other
involved.
questions. Thank you very much for coming, and good report. Can you add me to the distribution list?
Yes,
Of your
I would,
reports.
okay, I will do that.
Actually, add all the committee members.
Okay. I will do that. That way you will get all 28 recommendations and their responses and our responses to their
Put my foot
responses.
in my mouth.
That's to be careful what you wish for.
Can we get an electronic version?
Yes, we do it electronically.
Okay.
The one,
Katrina has all email addresses.
you have one of these organizations got a qualified opinion from
Yeah.
its auditors. That's a real big red flag.
Yes, yes, and we found that with the welfare funds.
Yeah.
Yeah, it is remarkable.
Thank you.
Thank you very much.
Thank you.
The lawyers are coming shortly. Due diligence.
What are we doing now? Which one is up now?
George Davis.
Good morning. I'm sometimes not good with buttons. Is this thing on? My name is George Davis. I'm the Deputy Director at the Mayor's Office of Operations and also the Director of Audit Services. Our Chief of Staff is passing around a deck with a few comments that will sort of guide the discussion today. Obviously, I want to thank Marjorie for the work that she does with respect to the external audits. Clearly, that provides an opportunity for agencies to have the benefit of an outside entity's view. I also want to congratulate Mike on his chairmanship. Bernie's an impossible act to follow. Good luck with that.
Thank you.
The Mayor's Office of Operations is responsible for following external audit activity. That includes audits by the city controller as well as other external entities. The purpose of that activity is to ensure compliance with the applicable issues that come up and govern the audits. It's also to facilitate an orderly process. Obviously, audits aren't necessarily the kind of activity that are always welcomed, and agencies as well as auditors have differences from time to time. And so we work to help facilitate, ensure a coherent process in that regard. We follow the audits from the outset to the closing, and let me just elaborate on that a little bit. We are notified when audits commence. We receive the so-called engagement letter. We participate in the entrance conferences, the initial meetings. We receive the reports as they are written, from the preliminary reports to the draft reports to the final reports. We also review and comment on agencies' responses. And with respect to the process, we are very much involved. Agencies know, auditors know, to keep us involved. And there's a deck there, there's a slide there that sort of lays out that process. I don't think that the audit process concludes once the final report has been issued. And in that regard, we track the implementation of audit recommendations. In fact, we've developed most recently a more robust database for tracking audit recommendations. I think you'll see from Marjorie's report there are over 450 recommendations in this year alone. And so to the extent that there are 400 or so recommendations on average from city controller audits, which may represent about half of the portfolio of audits. Easily, there could be 1,000 recommendations annually that are tracked, and we track them to the point that they get resolved. In other words, once the recommendation has been resolved, we then close the audit. We don't close audits until the recommendations have been addressed. In terms of agency responsiveness, there are differences as the process unfolds. I think it's fair to say that agencies respond to all the audits. You'll see those responses in the reports once you start getting them. I think it's also fair to say that agencies work to implement the recommendations with which they agree. Agencies oftentimes differ with how the findings are characterized, but they accept the good faith intent with which recommendations are written, and they respond to that. And so, for example, Mark, you asked the question about concessions. The Parks Department has a concession audit team. And in addition to the activity that was discussed here, the Parks Department audits concessions, and that activity is oftentimes worked in coordination with the city controller's audits. I think that might be the extent of what I have to offer.
I was just going to say, we have the internal audits from the controller's office,
Yes,
and then you have from the single audit.
yes. And so we
I mean, that's about the universe of it all. It's a lot, I know, but
yeah, we say that a little bit differently. The internal audits are audits that we would consider that are done by the agency on themselves. In terms of external audits are conducted by the city controller. We typically characterize that as 75 or so annually.
I understand.
The state
So
controller.
agencies do have their own internal audit department, and you don't get involved in that, do you?
We follow that activity, but clearly not as closely as we do the external audit
controller
activity.
or the
City controller, the state controller, the federal government, the single audit, all those.
We have state controllers still providing, yes.
Yes, the state
Come to
controller
think
does
of it,
about
yes, we
25
do.
or so audits annually, right?
Yeah, okay.
There's quite a bit of audit activity going on.
Any other question? Thanks, George.
Thank you very much.
Mr. Davis.
I'm gonna get some water while you, I don't call. You want more? I'll get you one. Thanks. Mr. Chairman, you've been deputized.
Hi.
Hi. Good morning.
See you all. Morning.
Could you please introduce yourselves and identify for the record the geographical boundaries? I'll follow up on my predecessor.
Will do. He used to ask that. Dan Biederman, President, 34th Street Partnership. Peter Cirillo, CFO, and Tim Scheck from KPMG, our auditors. And the boundaries of 34th Street Partnership, established in 1992, are roughly 10th Avenue to Park Avenue, 32nd or 31st Street to 35th or 36th Street on the north. So the whole corridor with Macy's, Empire State Building, Madison Square Garden, and the retail shopping district there. So we'll proceed just very quickly. It's no major changes since last several times we reported to you. The BID now has roughly a $13 million budget, of which the city assists us with assessments, as you'll note in the P&L, with close to $11 million. And another $2 million is brought in by business deals of various kinds. Running a balance, we've gone for an increase in budget over a 3-year period, which was approved last year. It goes into effect this year. Generally, I think I've said this before, the increase in cost of this business improvement district to its supporters is within the rate of urban CPI, despite the fact we've added a ton of programs since we were established in 1992. We took over 2 parks, Herald and Greeley Squares, and have added much more sophisticated ways of cleaning the streets, lighting the streets, and the like. And of interest probably to you is that there's still $12 million of debt outstanding from an issue that was originally way back $24 million. And this is using this technique that only Grand Central and 34th Street and Bryant Park have used, which is to issue triple tax exempt debt with a sign-off from the mayor. And then the stuff we build is contributed to the city's assets. So that's lighting, park improvements, trees, planters, everything you see on 34th Street that looks kind of unusual because you don't see it anywhere else, has been paid for through that debt and debt service. Peter and Tim can go into more detail about it, but the debt is totally extinguished in 2031. There is the chance that we'll do more of this because we're currently discussing with DOT and the Parks Department a major improvement to the look of Herald Square that we would like to pay for ourselves. And very complicated because we'd like to design it and build it ourselves rather than have it go through DDC. This isn't in the newspapers yet. DOT has been quite cooperative. but it's a complicated project to do, and we'd bring some of our major property owners in. So we may, the next time we see you, say we've gone back to the board for some more debt. But otherwise, we're burning it down, and it's now at 12 million, roughly. 12 million.
The people aren't afraid to sit in those,
Afraid to sit?
in the middle of the traffic? I'm teasing.
Oh, yeah, well, Bernie, I would say that Jeanette Sada-Khan's improvements have been adopted and expanded on by this administration, and it's been a success. And the reason it works for us is the traffic south of 40th Street down Broadway really is 10 or 20% of what it was, and it slows down. These improvements have calmed the traffic. So the public's gotten used to this, and it seemed like an odd idea at the time to many. I had to sell it to a couple of my owners, but they now are completely on board. So the city did a good thing. The city is regarded as one of the more advanced street pedestrianization municipalities in the United States, and others have emulated what the city of New York has done.
I have one minor accounting question. In footnote 3, you refer to property and equipment and cost less accumulated depreciation. What does the amortization mean in that context? You amortize debt, but I don't know how you amortize property and equipment.
Yeah, I actually spoke to the partner who set this up 20 years ago, and the thought being that because the district improvements were not ultimately owned by the partnership, although we have care, we paid for them, we have care, custody, and control, we don't own them. We can't securitize them.
I understand that.
They belong to the city, so that's why they use the term amortization as opposed to depreciation.
But is there a difference between the two? That is, do you have some that's amortized and some that's depreciated?
District improvement, everything that's called district improvement is amortized.
I see. And over what period of time?
And initially, it's usually over the term of the bond. So anything that was on the done with the original,
Okay.
It was 30 years, and now it's 20 years.
Mark, it might help to, once in a while I go through this with this committee. The section of the IRS code we used, 6320, allows a nonprofit, with the approval of the CEO of the city it operates in, to take advantage of tax-exempt treatment for bonds that it issues. So nobody has used this for this purpose in the country other than the BIDs that we created, Grand Central, 34th Street. It was first suggested to me by a guy I think you guys know, Melvin Mister of Chase. He was a public finance guy at Chase, I think was involved with the city, and Mel said, why don't you think about 6320? So it was a tremendous vehicle because rates were low, they've remained low,
Sure.
and the BIDs are willing to undertake the debt service if they can build and design the way they want. So all of this has happened with no cost to the city, and it has not been emulated. I thought every place all over the country would emulate it. Nobody has, so it's just us.
It's even more informative as an answer than I expected.
So that's the reason for this awkward thing, that we build stuff, and then, in effect, we're contributing it to the city, but it is on our balance sheet.
I got it.
Yeah, I never understood it either as a layman.
No.
Okay.
If there are no other questions, thanks, Dan.
Thank you, Mike.
Or Mr. Biederman.
Great to see you again, all of you.
Nice seeing you.
It's a good thing when there's no questions.
I've heard that.
What's next? That's the partnership. OPEB is next. Oh, that wonderful thing.
HDC building.
Oh, the next one on the list, Bernie, is OPEB. Yeah. Bernie? Yeah. OPEB. If we follow the order, it's OPEB.
No, this is HDC. I think they had a meeting, they had a name.
Oh,
That'll go. Come on.
Good morning. Could you please introduce yourselves?
Hi, I'm Kathy Bauman, Senior Vice President Treasurer.
Hi, I'm Rich Perlich, the Chief Operating Officer and General Counsel.
Mary John, the Controller.
Samantha Kalu, I work with the BY.
I don't think your mics are working,
Yeah.
since I failed that test.
Okay, good morning.
Good morning.
I'm pleased to present the corporation's audited financial statements for the fiscal year ended October 31st, 2017. The package you received includes the financial statements themselves, including those for HDC and its two active subsidiaries, the required supplementary information for OPEB and pension, and the Housing Revenue Bond Program financial schedules as required under our bond documents. I'm pleased to report that once again, no management letter was issued this year from our auditors. I'm also pleased to report that 2017 was another exceptional year for the corporation. HDC has maintained its position as one of the nation's leading housing finance agencies and has continued to play a central role in the Mayor's Housing New York program. In fact, 2017 was a very active year for HDC in terms of bond issuances and loan closings. 26 bond series were issued during the year for a total bond issuance of $1.5 billion in 2017. In addition, $160.8 million of proceeds were drawn down on previously issued bond series, and one new certificate of participation with the Federal Financing Bank totaled $103 million, for a total of $1.7 billion in proceeds for the fiscal year. Total HDC assets were $16.1 billion, an increase of $1.7 billion, or 11.85% from fiscal year 2016, due to the corporation's ongoing robust lending activities and bond financing activities. Total liabilities were $13.7 billion, an increase of $1.5 billion, or 12.3% from 2016, as a result of the corporation's ongoing debt and lending activities. HDC's total net position at fiscal year end was $2.5 billion, an increase of $204.8 million, or 9% from 2016, due to normal operating activities and non-operating revenue of grant income. During fiscal year 2016, the corporation early adopted GASB Statement Number 75 for OPEB. The implementation of GASB 75 resulted in an adjustment to salaries and related expenses on the financials in the amount of $1.3 million, a very immaterial amount. The increase to net position will allow the corporation to continue to play a critical role in the Mayor's housing plan and provide subsidies to the affordable housing developments that we finance. If you have any questions, we'd be happy to answer.
Your employees are members of the New York City Employees Retirement System,
Yes.
right?
We are, yes.
Not the state, the city system.
To the extent that people opt in, it's in the city system.
Some of them are still in the state system.
No, we don't have any
Everybody's
in the
city
city. It's you're either in the city system or you're not. You don't have to join the city system. It's a voluntary choice.
Why would somebody not join?
We also provide a benefit relating to a 403B because of our somewhat independent status. So some people opt for that, and then we match a contribution there. So it has a similar thing, but you have more control than with a pension. It's a choice.
It's also a function of how long you think you're going to be there.
Correct, that's right. I mean, the world has changed so that a lot of our younger employees are not necessarily thinking of a permanent city career. So for them,
403B they can carry
right,
someplace.
yeah.
I was puzzled, if I can, Mike, on page 5, you refer to a permanent loan on behalf of the city. What's a permanent loan?
A permanent loan generally means it's something when it's not a construction loan, it's a permanent loan. It relates to the idea of a construction period and then something that's a permanent period. So permanent is sort of usually like the
It's not
30
forever.
No,
No, it amortizes
No,
over the
it's a
term.
30-year or 35-year
So
term.
it's a term of art that I didn't understand, is that it?
Right.
Okay.
Regarding the management letter, was there any letter to management saying there were no findings?
No, we're not required to issue a letter if there are no findings. Just at the audit committee meeting, there is specific communications that were required to be
Yeah.
made, so we tell the audit committee that we didn't have any findings.
Okay, thank you.
I got a couple more questions. It'll take me a minute to find them.
You issue debt on behalf of the Housing Authority as well?
We have.
Not this past year?
Yeah, we've done several transactions for the Housing Authority over the years, and we often work with projects that are being developed on campuses, the NYCHA campuses, so as part of their efforts. But we've done significant financings, capital fund transactions, the most recently being done in 2013. We've also done participating in some of their privatization efforts through the RAD program, and so we worked through the federalization program with them after 2009 through 11. So we've often worked with them.
And going through some of the later pages, through HAC, you did a financing with one of the banks, Wells Fargo, for Stuyvesant Town?
Correct. So in an effort to preserve affordability at Stuyvesant Town, this is now a couple of years ago, we worked with basically through the city hall to enter into an agreement with the people who are buying Stuyvesant Town, and in it they agreed to a 20-year regulatory period, and in essence what the city did was by using HDC we were able to get a mortgage recording tax exemption. So for their $2.7 billion mortgage, it was exempt, which had a significant value. And then the other thing is they did have to pay the transfer tax. And what the city basically did was agree that it would, in essence, reimburse it. So we wrote a check.
Reimburse the transfer tax?
Yes. So HDC wrote, actually through HAC, wrote a check to the developer for the value of the transfer tax, and the city is reimbursing us for that over time. It was originally about $145 million. It's now down to $45 million. So what the city does is finance certain projects that we would normally subsidize. Instead, the city is adding its subsidy in.
There's a reference on page 29 to members of the corporation. You are a corporation, aren't you?
We are. We're
So
created.
what are the members?
The members are as created by statute. It's essentially the board. So we're created under Article 12 of the Private Housing Finance Law, and within that, the state sort of created that our board would be its members. So there's a 7-member board.
So instead of the board, it's a member.
It's the members, and so there,
Okay.
3 of them are ex officio members of the mayor's cabinet, OMB director, finance director, and the chairperson.
I'm
is-
just interested in the nomenclature. Don't jump to the point.
All right.
Now, why are you involved in, you're tax exempt, right?
Yes.
Why are you involved in taxable munis then?
As far as why do we issue them or why do we purchase them?
Why you buy them?
We buy them just as investments.
But if you don't pay taxes, why do you take the lower interest rate than a muni?
Well, if it's a taxable muni, generally we buy. So taxable munis,
gets a nice
for a period of time, we're pricing above other taxable securities. So buying the taxable debt of the city or the state was a good investment.
You-
I always ask you this because you're a knowledgeable guy. How many units are there in Mitchell-Lama, would you guess?
There's still, in the city, I think it's a little under 100,000 units. We've done a lot to preserve the Mitchell-Lama housing as Mitchell-Lama.
Sure.
Some of them have converted to other forms of affordable housing. We have a variety of different statutes. So, but Mitchell-Lama is something that is very important, and we came up with a new program as part of the Mayor's Housing Plan Part 2.0 to further do that. We did our last big push about a dozen years ago, and so now we're doing our next big push. I imagine that if I'm here in 10 years, which hopefully I won't, there'll be another big push. It's a continuing source of affordable housing for the city, and very important.
Did you join the city's pension plan?
I did. Please make sure it has money.
It was a great program.
No, I just,
We could use it again.
If there are no other questions, thank you for coming.
Thank you. Great.
Thank you.
They do a great job.
you know, you look at this, it's all this complicated stuff done. And it just is one form of subsidy after another. And because of the wrinkles in the tax law, otherwise you have these inefficiencies. One big lump of money would be better than all these little pieces if you could. Yeah, it creates all kinds of inefficiencies, though. Nah, I'd never do that. What's next? OPEB. Another great thing. You know,
Oh, no, no. Good morning, everyone. Would you like to introduce everybody?
Yes, I know we have a big crowd here. My name is Raymond Lee. I'm the Director of Accounting Services at the Office of Management and Budget. To my left, you have Mike Samet and Tom O'Hara from the Office of the Actuary, and Hope Goldstein, our auditor from Marks Paneth. To my right, you have Janice Aurora from the Miscellaneous Budget Unit at OMB, David Jetter and Steve Valoric from the Controller's Office of Bureau of Asset Management, and Frankie Chen from the Office of the Actuary. So I'll begin with a little bit of an overview. The plan, as you know, is composed of two parts: the Retirement Health Benefits Trust and the what we call non-OPEB trust, which includes contributions to the retirement benefits through the city's general resources. Some of these costs include the city's payments to the stabilization fund and the implicit rate subsidy. Going over some of the financial highlights, as you can see, there's not too much of a change in activity other than the increase in the net position. The increase in net position of almost $600 million is primarily due to the $100 million discretionary deposit that the city put into the trust, and also the $400 million prepayment for next year's expenses. And that kind of makes up the majority of it. The trust itself is nearly up to $5 billion with assets, and the benefit payments themselves have not gone up too much, about $100 million between this year and last year. One of the major changes this year for the plan was the implementation of GASB 74 and 75. GASB 74 is the statement that kind of dictates how the plan reports. 75 is more of the employer. 74 and 75 basically mirror 67 and 68, the two GASB statements that were implemented a few years ago for the pension side of the retirement benefits. In walking through some of the key changes of GASB 74, it didn't really have a financial impact. It was more on the note disclosures and the RSI, the required supplementary information. The impact of the net position and the changes in net position was actually zero. So some of the changes that happened were in the face of the financial statements. The major one was the investment income. The investment income, we used to split the investment income between the additions and deductions. The investment expenses would be in deductions. However, GASB 74 now requires that the expenses related to the investments be included with the investment income in the additions section. So it would be net investment income. I'll take this chance to address one of the comments the board made during the last meeting with the pension funds. We know that the wording for investment income, I think it was Mr. Kaplan who made the comment, investment income's a little vague. It is a GASB wording, but we will going forward split the investment income into the different components, the investment interest and the investment returns. In the notes, the major changes really were in the investment sections, the actuarial sections, and the RSI. In the investment sections, now we include a bit of a description on the procedures and authority for establishing and amending investment policy decisions, and you'll find that on Note 5. The concentration risk is now calculated a little differently. It used to be based on the total amount of investments, but now it's based on the fiduciary net position. It's not a significant impact. Net position usually wasn't that far off from the actual number of investments, given that the net position was, I think this year, 4.6 billion, total investments were around 4.9 billion. A new disclosure was added with GASB 74, and that was to disclose the annual money-weighted rate of return on investments, and you'll find out in Note 5 on page 14 at the bottom. Before passing it over to the actuary's office to discuss a little bit about the actuarial changes, you'll notice some major changes in the required supplementary information. We used to have a couple of schedules. One of them was the schedule of funding progress, and the other one was the schedule of employer contributions, which showed the actuarial required contribution, the ARC. Those two have been replaced with a schedule of changes in the city's net OPEB liability. So that schedule now shows the total OPEB liability, the total net position of the plan, and then the net OPEB liability. The other schedule is the schedule of plan expense, which is on the last page, which shows the components essentially of what this year's OPEB expense was. So I'll pass it off really quickly to the actuary's office to discuss about the actuarial changes.
Sure, thank you. So there are really two primary changes in 7475. Like Raymond said, most of the changes are really just to bring it in line with the pension statements, GASB 67, 68. The two biggest ones were, one, the amortization periods. So previously, under GASB 43 and 45, any changes in assets and liabilities were recognized right away, so they weren't amortized at all. Now, under GASB 74, 75, any changes in assets get amortized over 5 years. Any changes due to assumptions or experience get amortized over the future working lifetime of the plan. The other change, and this is probably the bigger one, is in the discount rate. So previously, we had been using the expected rate of return on assets, which had been, I believe, 4% for quite some time. Going forward, we can still use the 4% for the funded piece of the plan, which for the city's OPEB plan is pretty small. The bulk of the plan is going to use a yield rate from a 20-year high-grade municipal bond fund. So we're using the S&P bond fund, and that's going to change, every year depending on the yield rate at the measurement date. So, for example, as of June 30, 2016, the discount rate was 2.75, and as of June 30th, 2017, that had increased to 3.17. So we reflected a gain due to that change in discount rate, so that will be ongoing. And those are really the two big changes. Everything else was largely cosmetic.
Thank you, Tom.
If I could just ask, on page 6, where you talk about those changes, it talks about 10.9 billion. That's, just so that I make sure I got my head going straight, it talks about an increase in liability. When I look at the chart above, it appears as the 10.9 is reducing my liability. Am I reading something wrong?
It does look, yeah, no, yeah, the discount rate did go up. It should be a gain. It may be, so I would think that should be a.
So we actually reduced the liability.
Oh, yeah, it should be,
It's
yeah,
not
it should
an
be a
increase.
reduction.
Okay, just want to make sure I wasn't twisted backwards.
Right.
And then, again, what you partly did is you started to talk about those items that were attributable to 74, 75, and what were assumption change. Could you kind of quantify what was the big driver of that $10 billion reduction in liability?
It was largely that discount rate. So the drop in discount rate from 16 to 17 was the key driver in the assumptions.
Okay. And it wasn't where you say at the end, certain plan enrollment and election assumptions were changed. That was
It wasn't
minor?
as significant. It was a smaller piece. And actually, I think that went in the opposite direction. That wound up being a loss. So it offset some of the gain from the discount rate change.
All right, thank you.
Yeah, I was hoping to see in a footnote, because it's $11 billion, somewhat of a breakdown for what were the pluses and minuses.
And we can include that going forward. Sometimes we ask some, some groups may ask for that. We'll give it to them as an aside. We don't
Yeah.
typically include it, but it's certainly something we can footnote in future,
I
what
would find
makes
it
up
helpful,
the...
particularly if it's going to be $10 billion.
Right, sure.
And in this case, it was almost all the discount rate, but still, yeah, we should, it's a good point to break it out.
Because when I read it here, I was looking for what those assumption changes were that was driving this, which in fact, apparently it was not.
On page 4, what's non-trust OPEB?
So, like I said before, the plan itself is composed of both the trust, which is the irrevocable trust where the city puts in contributions, and also non-trust component, which is a series of payments made out, or refunds in certain cases, that the city goes through their general resources. So one of the items would be the city's required contribution to the State Health Stabilization Fund, the implicit rate subsidy. I believe there's the payment to the Management Benefits Fund, and also a couple of adjustments for the retirees GHI margin and the retiree senior care dividends. So essentially, it's just the activity that doesn't happen in the trust, but are part of the plan activity.
There's a lot going on behind the curtain. I have a couple of technical questions. Let me find it. In on page 14, you refer to, oh, sorry. If you go from 14 to 15, your style changes because you don't have the 0 zeros at the top. At note 5, you say you have something showing it's without zeros, and when you get to note 6, you don't have that. Not the biggest thing in the world, but then, on page 6, you talk about discount rate and results as of June measurement date are at present 2.75. It's not clear what you're trying to tell us here, so that
Which paragraph are you on?
I'm on page 16. The note says 3.17 per annum is the discount rate. And then you say that the results as of June are presented at, and you don't say that that's the discount rate. You don't say why the change. Maybe it's not necessary, but
I guess what this is meant to show is that the discount rate at June 30, 17 was 3.17,
And
at June
it-
30, 16 was 2.75.
right. Well, but the words are different. That's all.
I understood.
Then when you get to the monthly rates in the table, it's monthly rates of what?
Those are the per capita costs per person, the actual cost of the insurance.
Okay, well, I suggest that may not be as clear as it ought to be. And then I'm amused on page 17, you refer to a $100 contribution? Is that,
So that's actually the Medicare Part B premium. So if you have Medicare Part B, that is actually what you pay.
but that's per individual,
Right.
but it doesn't say that.
Oh, we can have.
It just reads, it's an odd number that way. And then when you get over to dependents, I couldn't figure out why male dependents are 4 years older than their wives, and then when you get to the police and fire husbands, they're soon to be 2 years older than their wives.
So it's actually based, we look at historical data, so we actually use like actual,
So
gender
what
counts
this
by.
is saying is that it's the, there are three or four categories of husbands and wives?
Yep.
Right, we don't have information on the spouses.
No, I understand the
Okay.
assumptions, they're just
Right.
making,
We do often see differences between different systems. So like
just the
teachers may
words
have
threw me
different
off.
enrollment patterns than firefighters and then police officers, which is why we try to do that to make it more accurate.
I had one other comment, I'll find it in a minute. Oh, if you go to custodian credit risk on page 13, it says the trust manages custodial credit risk by limited investments to highly rated institutions. That doesn't have anything to do with custodial credit risk. It has to do with the rating. You're saying that the high-rated institutions are holding your securities, or are you saying that the risk is somehow you're limiting it by having a AAA rated? It doesn't make sense to me.
I do believe it would be the institution that holds our securities, but we can check
I think
on that.
if what you're saying is that the bank that holds your securities is high-rated, that's
Yes.
not what you're saying. And secondly, I think that that's less of a concern. If it's registered in your name, you worry less about the credit standing of the institution. But this is just a different formulation than I'm accustomed to seeing.
Mike, only the mayoral agencies can use the retirees' trust to pay their benefits, or all the agencies could use it?
It's all. It's all.
All?
Well, I believe so. For example, the Office of the Actuary is not a mayoral agency, and we're in this plan, so.
Okay.
So I assume it's all.
Burning it on page 10, lists all the different funds. You need to use a microphone. On page 10, at the bottom of page 10, you see the list of plans. So it's everyone.
Right, it's everybody who's in one of the retirement systems plus TIAA CREF employees.
How strong a trust is it?
So the trust assets are up to about $5 billion.
I'm not asking you that.
Oh.
She knows why I'm asking you. Let's say the city wanted to invade the trust if it needed the money. You're an attorney, what do you think?
I believe once
You
it's
have to
put
retain
in,
it
you can't
first.
take
Oh,
it
you
back
have to
out. It
retain
only
it,
could be
okay.
used for the benefits.
The trust
I asked
itself,
that question years ago, it was hard to get an answer.
No, once it's in, it can't come
mean,
out except for the benefits.
yes.
What you're asking is whether the creditors of the city could reach it?
Well,
Probably
if
not.
heaven forbid they ever needed the money, could they invade the trust?
You have to read the trust.
What?
You'd have to read the trust.
Yeah.
Okay.
The trust itself is
Thought
irrevocable.
Somebody could give me,
The trust would pay the benefits, the city wouldn't pay the
I'm
benefits.
sorry?
In order, the way the city would use the benefits of the trust would be that the city would not pay those benefits, the trust would.
All right.
Right. So just to clarify that currently the city continues to
But if
pay
you
the
needed it
pay-go.
quick and fast,
It's such
But
a
all the
cynic,
benefits,
Bernie.
as stated, is still pay as you go.
Yes. So the city currently pays the 2-point-something billion every year through, as a contribution to the trust. What Mr. Spitzer is saying is that the city would, in times of need, pay it through only the trust and not through the general resources.
see, some years when the city was kind of flush with money, they would always add money to the trust. It's a good place to park money at, especially it avoids the regular pay-as-you-go. But if that's voluntary, could you look at it the other way? You'd have to read the trust documents, I
The
guess.
intent was that,
What?
the intent when the trust was set up is it could only be used for payment of
They
those
couldn't
benefits.
touch it?
Just for benefit payments.
Just for benefit payment. And in fact, the additional payments that were made into the trust were to strengthen the trust, not to be a budget balancing item.
I'm sure you
So over time, to the extent that additional money could be put into that trust, and the intent was to strengthen the trust.
Okay.
One other little question. You say that money market funds are classified in level 2 based on various money market funds that trade at NAV, don't they?
That'd be a question for down there.
I think it's down there. I mean, as far as I know, that's what they all do. And you don't go looking in the market to find out. You just check the net asset value. And the theory, that's when the whole of breaking the buck issue came up. So it's not a big deal, but I think maybe
Yeah.
it's not the way it works.
I think it's because it's
The other thing with the money market funds is we try to minimize what is invested. It just happened that they got funded at the end of June, and it's tougher to invest the money the last day of June by the...
I'm not questioning the investment. All I'm saying is the way you value a money market fund is you go check the paper and you see the NAV, and that's what you get your money out at.
But it's a fixed income
So
fund.
it's not a level 2 necessarily.
So it's like, so it's a fixed income fund. So it's going to get leveled as an unobservable price. But we'll look into that because I understand the point you make.
Okay. And a lot of these missing in the New York.
Well, I got a lot of comments that I'll give to Katrina for them. Are there any other questions? I thank you for coming.
Right, thank you.
Thank you.
When you hand yours in, take one.
I have some cosmetic.
Yeah, I'll take that.
Sir, when does both partners come back? No, just separate from this. When is the next phase of the actuarial audit?
They're working on the second phase right now, and they have some preliminary findings in the next couple of weeks.
Oh, okay.
But that's preliminary, but it'll be later this year.
Bernie, aren't you
How many years do you use to phase in gains and losses?
On the pension side,
Yeah.
15 years. 15.
5 or 6?
Well, on the assets, it's a 6-year smoothing method.
Okay.
Yeah.
You inherited that from your previous actuary, okay.
Right.
All right.
Bernie, aren't you on the board of HHC?
Yeah, I won't ask any questions.
Oh, we've missed you. You can't do that.
What?
Is Joe Buford still on that board?
Yeah, she's still there.
You can see the 400 is the discretionary that they're putting in. It's the version of a prepayment.
The place thing is.
I want to get rid of one of these books.
She said you could never invade it. I says, let's say you get to a labor settlement. Between me, you want it, you invade it. That's all.
The way you invade it is by not putting that, you can get 1
Yeah.
year's
Creepers,
contribution.
creepers.
Okay.
And so you can invade it over a 2-year period.
Okay.
That's the direct. But they also use 2 types of payments. When we're putting those payments in, they plan on strengthening the fund,
Okay,
leaving it.
okay.
But they also occasionally run a prepayment through here, so
I
next
keep
year.
Yeah, they were
thinking that
putting a
these
lot of
accounting
money
firms
into
could all
one
use
fund.
a
Now
better
they start-
prepayment.
All right.
Well, they've now decided to start running.
No, that's more.
But this, they say in the 2018, they'll pay, they'll put less money in the budget.
That's what I said. It's,
Thank you.
400 less.
it's,
Thank you, sir.
Good morning, everyone.
Hi, good morning.
Please introduce yourselves.
We'll start with me. I'm Jay Wyman, the Corporate Controller of New York City Health and Hospitals.
James Linhart, the Deputy Corporate Controller for New York City Health and Hospitals.
Joseph DeBroya, I'm Director of Fiscal Affairs, New York City Health and Hospitals.
I'm Mike Breen, a partner at KPMG.
Maria Tiso, partner, KPMG.
Camille Fremont, Senior Manager, KPMG.
Timmy Diallo, Controller, HHC.
Would you like to make some opening remarks?
Sure. Good morning. We're here to present the financial statements high level for fiscal 17 compared to 16. The financials are presented in 2 components. There were component unit, which is MetroPlus, our managed care organization. The rest is our business activities, related to New York City Health and Hospitals. Overall, there was a net decrease in net position of $194 million. And we ended the year at a $1.2 billion, which is consistent to what we had and slightly above 2016. The accounts receivable decreased by $64 million, which we gauge as positive because that means that we brought in some extra cash while maintaining our revenues, patient service revenues, which I'll call the billable revenues. Grants revenue increased by $502 million, requiring less appropriations from the city. And personal services has decreased slightly for the New York City Health and Hospitals portion. MetroPlus increased slightly because of the increase in membership, about 4.5%. And this represents a significant decrease for us on the personal services because we started to initiate savings in our headcount starting in November of 15. And we're down about 5,000 FTEs since that time, which includes the temp agencies, temporary help, et cetera. Operating expenses remain consistent with prior year, again, except for MetroPlus, which expanded their coverage to members about 4.5%. And KPMG did extensive testing on our liquidity. Every few years, they'll take a look at that. And I'm happy to say that they found no cause or alarm for a going concern. That's very high level. And if there's any questions?
It's an overwhelming thing to try to read and try to understand it all. I'm just curious, is someplace in here to tell how many people actually work for the whole organization? Is there a statistic?
It's not in there, but we do have just over 34,000 FTEs. That's full-time equivalents, so
Yeah.
just over 34.
It's much more.
Let me see. Yeah, but
Seems to get larger every year, right?
everything, the one that always astonishes me, I have nothing to do with you folks, but you sit and tell people what you do on this committee, and you ask, as I did the other night, I attended a dinner, put out one of the business magazines, and I had to say something, and I just finished reading about OPEB, and I guess there were 20 sophisticated people from the metropolitan area. Not one guessed how much the OPEB liability was. That's the one that always...
It is significant, and for us, it's $4.7 billion is the OPEB
But the city as a whole...
And the city is very big, they're much bigger than
It was
us.
$94 billion for the city.
So it's now, what are the statutory reserve investments that you referred to on page 21?
The statutory reserves are for MetroPlus, and because they're treated as an insurance company, they are required to
Have reserve,
to keep
okay.
reserves, and that's regulatory.
I don't know if you get that out of this document, would you?
Most of the document refers to the health and hospitals portion, not the MetroPlus, even though it's consolidated. There were also notes in the back related to MetroPlus. Because they are a discrete component unit, most of what's referred to is the health and hospitals portion.
I read with interest what you have to do and what's going on in the business, and my medical friends would disagree violently with some of the stuff that's being put in place to make better, more efficient doctors. And
Yeah, we have a number of initiatives going on now. Biggest one is probably our reduction to the headcount without sacrificing clinical care. Most of the reductions happen in non-clinical care areas. We have revenue initiatives to try to bring in the revenues that we've already earned. That's what I mentioned before on the accounts receivable. Getting that money in is very important to us. The fact that we've decreased some discharges, which are a basis for the revenue, we've been able to maintain the revenues, which means the collectability is a little bit higher. So we have a number of initiatives, related both to expenses and revenue.
let me point out that when you get to level 2 fair value, your disclosure of that is somewhat different in words than several of the others we've looked at. It would seem to me that maybe, not for you, but the city as a whole ought to have the same disclosures about these things for all of the units, rather than trying to understand why your disclosure is different than several of the others look at. That's something, I don't know where that ever gets handled and if it's worth doing, but it's too bad.
As Mark's looking, in the management letter, you mentioned, and there's no page numbers, so it was hard. We noted inconsistencies, but what type of inconsistencies and how material are they? Under corporate comments, financial reporting and alignment of finance resources?
So I could speak to that. I used to be corporate controller. A few years ago, I came back last January. In the interim, there was really no corporate controller, and there were some inefficiencies as people, the long-term employees had left, and with the knowledge that they had until we rebuilt that up. So some of the reviews for the financials were probably done in piecemeal rather than comprehensive. And one of the comments by KPMG is that we should look at everything together, which we put into place. And actually sitting at a table to the right of me, we brought in from Bellevue Hospital as one of our controllers to assist in the accounting. And we are planning on bringing on one additional person in the accounting area. So the accounting area really was, it was being done, but it wasn't being done efficiently. So when we fed information to KPMG, they noted that they had to do an extra work in trying to assemble what we've already put together. What we should be doing is, comprehensively putting together the package, so submitting it to KPMG for their review. So we got through the audits, but, the comment was, was taken, and we reorganized the department so we could become more efficient.
Just a note, on the same page, you have two different controllers.
Yeah, I am the comptroller. Yeah. I am the corporate controller. In some of our facilities, we had controllers, which we've now consolidated the controllers into the corporate controllers area. So we still have titles that over time we will probably change, but that leads to some confusion about the controller versus the comptroller. Yeah.
I see what you're saying.
There's something in here that I haven't seen about cash for other organizations. On page 29, you say deposits in the process of collection within the banking system are not collateralized. If that's right, and that ought to be said, I've not seen that for any of the other people who've talked to us about it. Mike, on page 29, is a sentence that the deposits in the process of collection are not collateralized. Now, if that's accurate, then somebody ought to reconsider the disclosure for any other city organization which is in the same position, which purports to collateralize its deposits.
One of the requirements we have and it's really part of our enabling legislation and our bylaws, is that everything is collateralized in the process, in the deposits. They may not be collateralized, but everything that we have, because all the money is coming into a separate bank account and then they're swept daily. When they're swept daily into our main account, they are all collateralized.
Well, I'm not questioning what you're doing. All I'm saying is if the deposits in collection are not collateralized or collateralizable, then that's true of every other city organization we've had here, and I've not seen that sentence in anybody else. So either you're right or they're right, but somebody will look at that.
Yeah, we will look at that.
No, I guess it's more, his comment is more, we should look at that.
Well, I'm interested too.
You could look at it for us, but.
Okay. I'm sorry, Mike, about that. Then there's some other language. On page 33, you refer to projects in multiple facilities for priority mitigation projects. What are you mitigating?
All FEMA-related stuff?
What are you
sorry, I don't
saying?
see it here.
Yeah.
Well, mitigation work, there is FEMA-related mitigation work since the flood of 2012, we've been working with FEMA on mitigation
Okay.
work.
I'll just tell you that to the lay reader, that doesn't convey what
Right.
you're doing there.
You're
It may
right.
not be necessary, but Now, when you move over to page 39, you got a whole bunch of language here about stuff that doesn't exist anymore. The final redemption date was September 24, 2008, and other things were done in 14 and 15. Why are you describing that which is no longer relevant?
We're just providing the history of the, what remains in the 2008 bonds.
Okay, that's the reason. Same thing on the next page. Now, I'll give you this because there's some words missing, I think, on 41, but now we're taking people's time. Oh, when you get over to page 44, you talk about some interest, that certain of these TELPs don't bear interest. Isn't there an implicit interest rate on those things then? I mean, they may not carry a percent, but typically those kind of instruments are discounted someplace, so there's some part of that thing is interest and not all principal.
Oh, you can say that.
That's fine.
I'm sorry, I didn't see which section it was.
It's on page 44. You say that HHC does not pay interest on taxable 1, TELP 1, 2, 3, 1, 3, non-interest bearing. But anytime in my life where that happens, there's a discount. I'm very tight for time.
Well, take a look. I believe it was immaterial, and I think that's what it was. We'll have to take another look. I don't
Take a look,
remember.
because I've never seen an accountant who let me carry that at par when there's an implicit interest rate. I think, Mike, that's enough.
Are there any other comments on the financials? If not, how about the management letter?
That was interesting.
One other question on the management letter. You had mentioned $40 million in overpayments as part of Metro Plus claims. Was that recouped?
Yeah. You want to speak to that?
Yeah, well, it was actually $37 million, and it was over a 9-year period, and we've reached a tentative settlement of $30.5 million with both of the providers. So legal's right now working. We have inside legal, outside legal, and Metro Plus working to achieve this settlement.
So it's roughly over 80% of the value.
Big fat management letter. Now, one little thing that's always one of my pet peeves in my organization, when somebody leaves the organization, his or her access to anything in the systems is not waited. It's done that minute. And yet here you talk about 5 days as a window where they're still accessing. Yeah, we don't allow that to happen. And I know that the best practice is, I hate that phrase, is with the minute you're out, you're out. And you can't, so I would urge you to think about that one.
We're constantly updating the policy on security and passwords, and we've been getting much better over the last couple of years in that regard. Part of the reason is we have multiple systems, and as we transfer over to a more common system, we just implemented PeopleSoft in July, and so most of our financial systems are. So I think that, that in the future we will get better, but it's a good point, and we will continue to look at that.
I just sat through one of these sessions, one of the professionals coming in and talking about security, and it was, there are two kinds of enterprises, those that have been hacked and those that have been hacked and don't know it. And you particularly with the data you have, having something that an expert will say is best practices is a good idea, even if that word is overused. So I urge you to think about that promptly.
Well taken.
Pardon me? Oh, all right. I'll shut up.
If there are no other questions, thank you for coming this morning.
All right,
Yeah.
thank you.
I
Have a good day.
Did you give me your missing bits? Yeah. Oh, all right. Who do I give it to? This has the notes about my appointment for tomorrow at the hospital. I have an MRI. I copied it out.
I'd like to recess this meeting at this moment and then entertain a motion to go into executive session.
I move.
Second.
No, I'm okay.
Good.
I move we end the executive session.
I second it.
Okay, I make a motion to come out of a recess to the regular meeting.
And I move we adjourn.
I second it.
I'm good at this.
Good. Thank you very much, everybody.
Believe it or not, I'm known